Welcome to our Retirement Optimization Series. Today, our topic is retirement income planning. My name is Nell Kordick, and I am Vice President and Financial Advisor with Bogart Wealth. Thank you so much for joining us today, and we hope you enjoy the presentation. For your convenience, I do have both the question and answer box and the chat box open, and we'll try to answer any questions during the presentation. Bogart Wealth is a registered investment advisor firm. As a fiduciary, we place the interest of our clients above all else. We always act in the best interest of our clients. At the current time, we have over $900 million in assets under advisement, and we are the trusted advisor to over 700 households, with about 90% of those clients are major oil company retirees. We use institutional custodians like Charles Schwab to hold and safeguard our clients' assets. So what does a fiduciary firm mean? First of all, it means our clients' interests are number one. Secondly, we always hold true that transparency on fee structure is extremely important. It is very important to also fully disclose to our clients complete information, and balancing on all of that is that we absolutely believe in ethical business practices. We are a team of highly experienced professionals. We have our financial advisor team, our financial planning team, our portfolio management team, and our partnership with a CPA firm. Together, we can provide strategic and comprehensive advice to our clients. We also, for convenience, have 3 offices, one located in McLean, Virginia, one located in Houston, Texas, and one located in the Woodlands, Texas. At Bogart Wealth, our mission is to always help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So today, we are actually continuing in our Retirement Cash Flow Optimizer series. At Bogart Wealth, we have a fundamental belief in the value of knowledge that brings to our clients as they are making decisions. So we have created a series of financial seminars available on our website for your review. We're always adding additional presentations, so if there's ever a topic that you would like to learn more about, please let us know, because we are creating new series over time. Some of the topics that we actually have already in place are retirement planning timelines, Social Security planning strategies, tax planning, estate planning, NUA strategies, long-term care planning, Roth versus traditional 401ks and IRAs. We also have done seminars on the Secure Act, on the CARES Act, that really give our clients and more information that they can make decisions around. So today, our topic today is discussing the benefits of retirement income planning, and we will then go into what is the income planning process. But before we go into that, I would say that planning for retirement income is one of the most important parts of looking forward into your retirement future. If the planning is done correctly, it will give you tremendous peace of mind. If it is not planned out correctly and there's no strategy in place, it probably will add future stress to your life, or it could add future stress. Good, consistent cash flow is one of the main keys to a successful retirement. So why should you engage in retirement income planning? Basically, in terms of their decisions that you need to make before, during, and after retirement. If you have planned ahead, you will have already understood the many options and choices you have, and also understanding the pros and cons of each decision. It is critical to understand your cash flow. Understanding and estimating what your expenses are key, and understanding where that income will be derived from to cover those expenses is also key. Planning will help you create a sustainable withdrawal strategy that works for the long term. It will also help you to establish a baseline and will offer discipline to your cash flow both now and into the future. And finally, planning is not a one-time event. Life happens and you need to adjust. Therefore, it is important to completely monitor and update your plan on a continual basis. So what is important to you? It is your future. Everyone is unique. And so planning allows you to create your own vision for your future. Planning allows you to think about all of the what ifs that are important to you, both good and bad. Planning also allows you to consider all of your goals and concerns, and all of those things are unique to you. Everyone will create a different plan because everyone has different priorities, and it's important for you to recognize what your priorities are and what you want your retirement future to look like. As you are incorporating your plan, however, there are lots of considerations that will impact your plan. First and foremost is family. You have to think about, will there be someone else that you need to provide financial support for? And that's extremely important to think about all the elements that would impact you in that regard. Secondly is health. What type of retirement are you planning? How can changes in your health affect your financial situation? Third is your home. There are lots of decisions to make around where you want to live in retirement. Sometimes people will want to move to a larger house. Sometimes they may want to downsize. Sometimes they may want to have two homes. So any of those choices all have costs associated, and we must plan for those costs in advance in order to make sure that the plan will accommodate it. Fourth, you must consider your lifestyle. So your lifestyle now and in retirement are both important. What do you like to do? What do you want to do? And do those activities cost money? Or will you need to buy extra equipment or quote unquote toys to accommodate all of those lifestyle changes? Work. There's sometimes, even though you're retired, some people will actually want to incorporate some type of work into their retirement years. It may be volunteer work. It may be starting another business. It may be some type of a collaboration as far as consulting based upon what your previous career had been. But you want to consider, what is the time commitment? What are the resources needed to make that work happen? And what is the financial reward that you will actually come from it? In addition, if it is income related, you also want to incorporate additional ways of helping on your taxation. It's very important to take that into consideration as well. The next area to consider is your legacy. And this is really a personal choice, but if you do have the desire to create a legacy that you will leave to some heir, you want to make sure that that is incorporated into your plan and accommodate it. And finally, you want to understand from a mind and spirit, what do you really want your retirement to look like? What is the atmosphere that you want to create? How much activity do you want to have? What activities do you want to participate in? All of these questions should be addressed with both partners in the relationship. Have a discussion and make sure that everyone is on the same page for your future. There are some common goals that clients have over time mentioned to us. As you can see, the top three have to do with their financial situation in retirement. For instance, number one is a secure, reliable retirement income. Number one priority, a retirement income that keeps up with inflation and not worrying too much about having enough money. All three are associated with retirement income. It is so critical that this is a topic of discussion very early on, but it's also a topic of discussion every single year to make sure that you're on track. Plan in advance, and this will give you peace of mind. Plan ahead. There are also many risks in your retirement. The first is longevity. And really, when you think about longevity, you want to create a plan that will work for you if for some reason that you passed away tomorrow or you live to be 120. You want it to work at every step along the way. Secondly, inflation is a key factor that can be a huge risk for retirees. We have lived through a period of very low inflation recently, but increasing inflation will put a large risk to your future purchasing power and needs to be accounted for in your plan. For example, $50,000 today is equivalent to only $23,880 in 25 years. The third risk you need to be aware of is market performance. And in this situation, you want to really ask yourself, can your portfolio, and actually more importantly, can you handle market fluctuation? Managing your income flow during market volatility is key. You want to, again, create a sustainable income flow that will handle both a sequence of market returns as well as market volatility. The fourth large risk that we want to notate is healthcare. And this is truly the big unknown. Healthcare costs have probably increased faster than the average inflation rate recently, and we actually are forecasting that in the foreseeable future as well. And so you want to actually plan for this and make sure that you understand that this continues to be one of the largest variables. So what is retirement planning? Things to include in your plan, because they are variables and can change over time, are critical. And some of those particular areas, first and foremost, is spending. To have a really good, clear, full picture of what your spending is. And I think sometimes people think about, well, this is what I spend on an average monthly basis. However, they forget the one-offs that are only paid once a year, or only paid twice a year, or only paid every 3 years. And those type of spending are critical to be included in your plan as much as those normal monthly expenditures like utilities and insurance and things like that. Secondly, your lifespan. You want, as we discussed in the previous slide, you want to be able to make sure that your income stream is continual all the way until whatever age that you pick in your future. Take into account inflation being high or low. Be ready for either one. Investment returns. Key for planning is plan for lower returns than you actually will expect, and also plan for volatility and make sure that your plan will withstand both of those situations occurring. Taxes are very important. Do not forget the impact of taxes. Make sure they are included in your plan. Retirement income planning is a never-ending cycle. The first area that you want to make sure that you really spend some time is to establish your goals and concerns. And you want to think about retirement as goals that you may have never actioned before. So this is your open slate to create what your future wants to look like. Establish your cash flow basics. So understand the basics of what you are spending money on. Create a full analysis of what your future looks like. Secondly, is to establish an investment strategy that matches your risk tolerance, but also is in line with your spending plan. And during this phase, we would also advise that you conduct a full review of any current and future risks to your financial situation, and to conduct a full review of your estate plan. Make sure that one document does not conflict with another document. And the fourth phase of the retirement planning process is to continually the third area is to create a withdrawal strategy. Plan for the unexpected. So you have one number that's your normal amount of withdrawal, but always have in your plan an extra bucket that is the unexpected expense. They will occur, and they occur when it's the least convenient, but they will occur. So make sure that that is somewhere in your plan. And if you're lucky enough that you never have those unexpected expenses occur, then that only helps your plan look rosier at the end. And the fourth step is to really monitor and review your plan ongoing. Life changes, and the critical part is you want to be able to react. You want to be able to be nimble, and you want your plan to be able to react, and that you've already thought in advance of some of those changes that could occur. Some of the things that you'll need to understand during your retirement income plan is, first, before you build your income plan, you want to make sure that you understand what your income needs are and what your sources of income are. So really have a very clear expectation of where the income is coming from. Then you want to understand and try to establish how much you will need of income each year. The critical thing is that sometimes income will change over time. So what you may need in your early years of retirement may be vastly different than what you need in your later years of retirement. As you've probably heard the expression of go-go, slow-go, no-go. Typically in your go-go phase, you're very active, you're probably traveling a lot, you're experiencing a lot, and it probably is a more expensive phase of your retirement. Typically, after the go-go stage, people will start to slow down a little bit, and you'll go into kind of a slow-go stage. That's where you're not quite as active. The spending may be reduced slightly, and then you go into what we call a no-go stage, and that's when the activity diminishes quite a bit. Typically, during that phase, healthcare costs will probably increase. You want to realistically estimate your expenses, and we recommend thinking about them in three separate buckets. The first bucket to think about is regarding your essential expenses, and we want to call those your needs. The second is your discretionary expenses, call those your wants. And the third is all of the unexpected expenses, or the money that we put aside for future wealth transfers to your beneficiaries. So when you're thinking about your different choices, think about your essential expenses as your food, your housing, healthcare, mortgage, insurance. Your discretionary expenses are all the fun things that you like to do. Your entertainment, your travel, gifts, club memberships, etc. And then you want to create a bucket for those unexpected emergencies. And that's where it really is a topic of discussion to figure out exactly the right amount for that. And then finally, when you're thinking about your spending, are you estimating an inflation factor in there? It is critical to put an inflation factor in your spending in order to accommodate that particular area. So this is a survey that was actually done, I believe, in 2018, and this really shows what the the median spending across the United States is. And for couples that are in their 55 to 64 range, it's about $66,000 a year. And again, this is a median number. But what you can see is that as they age and they go into the age of 65 to about 74, most of the expenses are going to decrease, with the exception entertainment has a slight increase and healthcare has a pretty major increase. And then when you get into the age group of the 75 plus, you see that all of the categories have decreased quite substantially, and except for healthcare, and healthcare increases quite a bit. And as we said, that's one of the big unknowns. And so in the later years, that is one thing that you do have to plan for, is making sure that those healthcare dollars are available to you. So the step one continued is after we've looked at inflation assumptions, because we are so concerned with what healthcare costs are going to do, it is very important we typically will put healthcare costs at a higher inflation factor than other costs, just because they have in the past been increasing at a higher factor. When you're identifying your income sources, identify everything. So we know that the obvious things are Social Security. If you've got any pension income, the gap will be the personal savings and investments, but then make sure you're including any rental income that you may have. If you're planning to continue to work or be involved in some type of a business, what are those earnings that will be attributed to your household income? If you anticipate an inheritance, if you're anticipating a sale of a home that you will downsize and you'll have a windfall, that's important to put into the equation. If you want to look at considering or talking about doing a reverse mortgage, that's important. And so basically, when you first start, it's important to start your plan and then determine if your assumptions will actually work. So that's the first step, is to really understand these are our base assumptions. What do the results look like, and are they going to work, or do we need to make any adjustments from the very beginning? When we look at the different sources of retirement income, first of all, Social Security, it's never meant to take up and replace your income. For US median incomes, it might typically replace about 40% of the income. However, for most of the typical oil industry employee, it will probably only cover anywhere in the 15 to 30% range, and probably, closer down into the bottom area of that. Pension income can also replace anywhere from maybe about 12% to 60% of pre-retirement earnings. It depends on your age, your service, and your Social Security. Typically, the formula is 1.6% times your year of service times your average pay minus the Social Security offset in order for it to be an income for life benefit. But again, a typical career employee that might work the 35 plus years is probably going to have about 50% of their pre-retirement earnings involved in their pension. And so where does the rest of the money get made up? And that really, the gap there comes from your 401k, your savings plans, your IRAs, any other additional savings that you have, and an income stream is created from that for your retirement years. So when you're looking at Social Security, this is a graph that really shows and depicts what the effect of either, you can look at it one of two ways, your pre-retirement income, which typically will also equal your post-retirement expense need. And so if it's low, then Social Security is probably going to cover a good percentage of it. However, the more of the pre-retirement income or the post-retirement expense coverage need, the lower the amount of your Social Security that will cover that. So that's important to, as far as a consideration in that regard. Looking, very similar type of graph involves a pension benefit as well. So this is kind of just depicting average pension benefits. If it is a situation where you've had about a 15-year service in terms of years of service, and you obviously are beginning at your age 55, depending on what your age is, you're probably looking at anywhere 12% to 20% covering your pre-retirement income. This increases dramatically, obviously, with the years of service. So as your years of service, 33 years and going on up, you can see it can go anywhere from about 35% of your pre-retirement income up to about 60% of your pre-retirement income. So years of service can make a dramatic difference in what your pension amount, your pension payout will be. And that is one thing that we do advise doing a pension analysis to understand what your best choice is in that regard. The critical thing, and this is one thing that you will hear me say several times throughout this presentation, is as you are going through this process, it is critical to create your plan. At Bogart Wealth, we offer the opportunity for you to have a one-on-one financial strategy session with us. We offer financial planning services complimentary. There's no obligation, and there's no additional requirement on your part except to participate in the financial planning strategy session. We think it will be well worth your time, and we would very much enjoy being able to offer that to you. Think about what your retirement future can be, and really look at it and make sure that we're covering all of the different assumptions that need to be in your retirement future. Step number 2 is really involving your investment strategy. So step number 1 is really understanding what are your requirements for retirement income. And step number 2 begins the process of how do we create that income. So it's really important to understand what are your choices. And there are many strategies that can achieve different objectives. In this particular segment, understanding that you can also incorporate many of these different strategies at the same time. And the ones that we're going to go over today are really some basic strategies involving annuities, bond ladders, income-oriented investments, fixed asset allocation, and dynamic asset allocation. And going into that area, before we really discuss them in detail, the one critical place that can destroy your plan is your own emotions. Be aware of your own biases and your own emotions and protect yourself from them. Again, this is a great place where your financial advisor is critical to your success, because they will talk with you about what the emotions that you're feeling. They will talk with you about what has happened in the past and fully understand what has changed in your life to have made a change in your emotions. Several to be really careful about are fear and or greed. And so both of these can cause you to actually lead to buying at a high price or selling at a low price, which are both can create huge mistakes for your overall long-term success. And our process is designed to help prevent you from making the wrong decisions based upon an emotional situation. We want to make sure that we are helping you to build a portfolio that will protect you on the downside, protect your essential expenses with a foundation, and to employ strategies that can withstand volatile markets through understanding what are your withdrawal strategies, what are your spending and harvesting strategies. And it's just important to having a very well thought out plan can help you maneuver through volatile markets. And obviously we've just been through a very major one recently. So the first area of investment strategies is annuities. And before I start any of these strategies, I do want to make sure that I put out there that this is in no ways any type of a recommendation. This is meant to be an education of what some of these vehicles will do. Each person is unique, and a full understanding of their unique situation, their risk tolerance, and what they're trying to achieve is required before making the right recommendation. So regarding the 3 types of annuities, annuities are basically fixed, indexed, or variable. And with a fixed with a fixed annuity, it's very similar to a bank CD. It has a fixed rate of interest. It typically will not allow you to lose principal, and it's invested in a general fund. At the other extreme is a variable annuity, and a variable annuity acts very similar to a mutual fund. It is typically invested in some type of a market security, so there will be volatility within the account, and the actual account is held in a separate account. Between the two is really a hybrid model. We call it an indexed. It typically allows some fixed parts to it, and it allows some participation of the market to it. There will typically be in this type some type of a floor and some type of a ceiling, both on the downside as well as the upside. And we can certainly explain more in depth with you in your own particular situation, but that's a quick overview of annuities. Second area is really bond ladders. And this is, we're getting into the section on understanding different kind of increased risk as we're going through all of these different components. So with the bond ladder, and this is a very simplified example, is really what you're trying to do is to always be having liquidity in your portfolio, and always being able to take advantage of whatever the current interest rate environment happens to be. So for instance, creating the bond ladder, and let's just hypothetically say you've got $100,000 for 3 separate bonds. Bond 1 would be invested for 1 year. Bond 2 would be invested for 2 years. Bond 3 would be invested for 3 years. When bond 1 matures, then it gets invested for an additional 3 years. Bond 2 matures, the same thing. And as you can see, you're creating a situation where every year you're going to have something new maturing. What this does is it gives you 2 things. One, it gets you able to take advantage of prevailing interest rates, so that will certainly not lock you into something that is the wrong type of interest rate for a very long period of time. But it certainly also gives you the advantage of, in advance of something that you're going to need liquid funds for. It gives you the opportunity to plan accordingly as bonds will mature. So that's really the purpose of a bond ladder. Looking at the third area is really understanding where yields can come from. And this is just a very big picture and historical returns by, as you can see, in some cases, interest rates today are not where they have been in historical, but when you look back over a long period of time for historical returns, bond ladders probably in the neighborhood of 2.5 to 4.5. Different types of income funds, whether they be corporate bonds, adjust rate bonds, mortgage bonds, foreign bonds. Preferred stocks usually have a little over 5% average return. Royalty trusts will have anywhere from 7 to 19%. Dividend stocks anywhere from 3 to 7%. The whole purpose of this is to really look at all of these elements of choices for yields and compare it to what the Treasury, 10-year Treasury is, and right at 0.7%. So when you look at the comparison, yes, there's definite risk that's associated with all of the different choices. And that's one component that you're always discussing, a risk versus reward. But it's important to understand that there are many more options for yield other than just US Treasuries. This gives you just a very quick visual on what the US Treasuries have done. The blue line is what they've done this year, and the orange line is where they were a year ago. And you can see quite a dramatic difference in what has happened in 1 year. This also gives you just a perspective of conversation between growth and dividends. And so that is always a constant thing to be thinking about. And typically, again, the reason for why you want to have diversity in your portfolio is a lot of times when you're having a shift from dividend income, then you're typically seeing it going into capital growth and vice versa. And so it's important to understand that over time, dividend growth is usually greater than inflation. And so that's really one important component to be considering. This is a graphical example of dividend growth, and this is by no means meant to identify one particular stock or to make any type of a recommendation. But what we've shown is just a difference in a managed account of prime income that is a managed account that we actually manage related to dividend producing stocks versus ExxonMobil having one concentrated position. And so in the top graph, you're seeing what the market values have been. And again, not to pick on any one stock, but you can see it's been up and down, but not a tremendous amount of growth over the last 20 years. Whereas a managed portfolio where you have the diversity of lots of different companies has been shown to be able to give you a bigger lift regarding the market price. The chart in the bottom really shows the advantage of getting a more sustained level of dividends. And over the last 37 years, ExxonMobil has certainly shown to have grown at an average annual rate of 6.2%. But you can also see where a managed portfolio tends to even perform a little bit better in that regard over a long period of time. This page is a very similar story, except what we've done is just compared it to an overall index of dividend producing stocks. And as you can see, again, something that's strategically managed has typically outperformed both in the value as well as in the dividends paid. Asset allocation is really important when you are considering what your future growth of your investments to be. And typically, when you're thinking of asset allocation, there are lots of discussions that we would have with you regarding where your risk tolerance is, what you're needing to achieve in order to meet your income objectives for your investments. But it's also important to realize that when you're thinking about your asset allocation, that typically you're going to have some component of bonds and some component of stocks. And when you look at an overall portfolio in typical markets, and there's always exceptions, and we can certainly identify some in history. However, on a general rule, when stocks are outperforming, bonds were probably underperforming, and vice versa. And when you've got a portfolio that actually has a combination of both, for instance, like a 50-50 portfolio, will take on a little bit less risk and even outperform where the bonds are. So it's important to realize the effect of having both components in your portfolio can be a big advantage for you. There we go. So then the next area is understanding why dynamic asset allocation. Dynamic asset allocation is when you are strategically making changes to the portfolio based upon different trends that you are following. And so one of the things to keep in mind is when you look at the beginning of the 20th century, railroad stocks actually represented 63% of the US equity market, but only represented 0.2% at the end of the 20th century. Similarly, Russia, India, and Austria-Hungary represented 25% of the global equity market at the beginning of the 20th century and less than 1% a century later. Things will change. It's just very important to be aware and to make changes and when things occur in the market. This is a slide that really depicts some of the multi-year declines that have occurred in the stock market probably over the last 150 years or so. And so again, in terms of when you could have avoided any of those major downturns, could have had a positive effect on your long-term portfolio. So, but I want to emphasize, dynamic allocation is a process. It is not a timing method. It is based on actual trends, not on beliefs or predictions. The flow of funds will create the market price trends. And typically, prices reflect market reaction to geopolitical concerns, economic upturns and downturns, industry or sector opportunities, and interest rate changes. And so when you're looking at dynamic allocation, you're paying particularly amount of focus on really ranking asset classes according to their relative strength. You're aligning allocation typically to the strongest asset classes. This is a chart that actually goes back 20 years, or well, almost 20 years, and it shows actually what is the top performing asset classes per year and the bottom performing asset classes per year. And as you can see, there's really no pattern. And so the key component is to be able to take advantage of being where you need to be when they're high performing and being out of something when it's low performing, or buying into it as it's working its way up. And this is important in terms of your dynamic asset allocation. So for an illustrative position, we want to go back and kind of give you an idea of what had happened before, during, and after the financial crisis of 2008 and 9. So the first area, if you look at 2008, and this is basically January of 08, we were really pretty well diversified in a portfolio. We were showing emerging markets, we were showing growth, we've got a little bit of bonds, we've got some healthcare, we've got some commodities. Then looking forward, when we get down into, I guess, probably July of '08, when you started to see the first banks failing, then you start to see, okay, we really need, we converted the portfolio much more to cash, still felt pretty good about having a technology component, and still had a small amount of commodities during that time frame as well. Then we get towards the end of 2008, and we're starting to feel like, okay, there's still a ton of volatility. And we actually then have converted to be the total portfolio to either all cash or government bonds. And then as we start to experience the recovery, now the recovery really started, now we can look at it in hindsight and see that it really started in March. However, a dynamic allocation will tend to make sure that we're on the road to a recovery before we really go back in. And so sometimes you will see it lag behind truly the bottom part of a cycle, but you can see that we're now feeling like the recovery is pretty strong, and you see a pretty well diversified portfolio at that particular time. So dynamic allocation versus fixed asset allocation, and this is important to understand that when you're looking at dynamic allocation over a long period of time, it will typically outperform. However, when you're looking at it on any given year and in a short period of time, then you will see that sometimes either an index or the S&P 500 will outperform. So it's important to understand that it will, over long periods, it will outperform, but over short time, it may have some lagging to some of the different indexes. And this is also in terms of looking at, this is a situation where here you're looking at dynamic allocation versus a fixed asset allocation, and you're getting a very similar type of review as well. Market cycles will happen. There will be good markets, there will be bad markets, and the key is that you want to be able to react to regardless of what market that it happens to be, and you want to make sure that you're comfortable with the different investments that you have allocated accordingly. Step 3 is to establish a withdrawal strategy. And so in this withdrawal strategy, there are several different types of income that you can, of ways that you can create income. First is really taking off the income that the portfolio is producing, meaning that you're going to withdraw the interest and the dividends. Secondly is a bucket approach. And what this means is you allocate certain investment accounts to be liquidated at certain times to accommodate what your short-term, intermediate, and long-term needs are. And then the third approach is a systematic withdrawal approach. And this is basically taking pro rata withdrawals from a well-balanced portfolio on a systematic basis, whether that be monthly, quarterly, annually, but some type of a systematic withdrawal approach. So when you're making choices, you do have to make choices on where do you take the money from first. So you have non-qualified accounts, which are accounts that basically have already been taxed. You've got qualified accounts and you have Roth accounts. And so typically we start with the non-qualified, then move to the qualified, and then move to the Roth. But not always the case. Again, in everyone's individual situation, it can be very different. And that's where we, as your advisors, will be able to help you understand and make those decisions. The second component when you're thinking about distributions from your portfolio is understanding how do RMDs work. So required minimum distributions will typically start at age 72. That went into effect with the CARES Act this year. And they require you to withdraw a certain percentage every year from your IRA accounts. The percentage, unfortunately, increases with age. You can always withdraw more, but if you don't withdraw enough, there is a 50% tax penalty. So it's critical to make sure that you do withdraw as appropriate. The important consideration that this is another aspect of your pre-planning for your retirement income is to also take into account what would be the effect of doing a Roth conversion early on before you're required to take your required minimum distributions. It's an important factor, can be different for everyone, but in some cases, it can actually reduce what your total required minimum distributions are over a long period of time, and it can also reduce what your total taxes are over a long period of time. But it is definitely worth doing the analysis to see if it makes sense in your situation. This is a chart that just basically demonstrates the required minimum distribution percentages. So as you can see, at age 72, it's going to be 3.7%. At age 120, it's going to be 50%. So it does go up as time goes on. The whole purpose is the government wants to make sure that they tax what you have saved into a retirement account at some point in your life. The Roth conversion, and this is the analysis that we actually will run, and really what we're looking at is if you're in a low tax bracket early, which means probably from the time you retire until you start to take your required minimum distributions, well, what if we actually during those years converted some of your IRA accounts into a Roth? Granted, yes, you've got to pay some taxes on it during those years, but you're at a lower tax bracket. And what that does is it takes it out of the Roth, takes it out of the IRA bucket, which means that you don't have to ever take required minimum distributions on that portion of your assets. This is an example of just showing kind of what the difference could be. So as you can see on the left-hand chart, this shows what your marginal tax rate is. In the early years, the base would have been 12. You're going to bump it up to 24 by taking a Roth conversion. However, in those later years from 2033 to 2049, you would have been in a 35% tax bracket because of the RMDs that you would have had to take, and it would reduce you down to being in a 24% tax bracket. And on the right hand or the middle chart, it actually shows the difference in those dollars. So for instance, in 2041, you would have normally had to have taken a required minimum distribution of $727,000. And by doing the earlier Roth conversion, it reduces that down to $490,000, which also reduces your overall tax bill. So it's really a consideration that's important to look into and see if this is a right solution for you. Tax planning is critical. We do not know what taxes are going to be like in the future, but it is important to always be thinking about decisions with future tax consequences. Understanding how all of your income is taxed is critical. So for instance, Social Security may be partially taxable as ordinary income. Pension and annuity income is taxed as ordinary income. Interest income is taxed as ordinary income. IRA and 401k distributions are taxed as ordinary income. Dividend income and long-term capital gains are both taxed as capital gains. Roth IRAs are not subject to taxation. And then typically your liquidation of investment principal, with the exception of IRA and 401k distributions, are also not subject to taxation. But it's really important to consider all of the sources and what their taxation will be as you are planning out your income in order to maximize the amount that's left in your pocket. The whole point is that we want to hopefully help you pay less taxes over the long term. This is just an example of what the rate structure looks like. Ordinary income tax rates can go from 10% to 37%. Capital gains tax rates can go from 0 to basically 23.8%. Step 4 in the process is to review and monitor your progress continually. As I said at the very beginning, life changes, constantly upgrade it. Make sure you've got in there a provision for unexpected expenses, and don't wait until it's too late to make adjustments. It is critical that you're looking at this on a constant basis so that all of a sudden it doesn't become a crisis. When you're early on in your retirement planning, you've got a lot of years to make adjustments. If you haven't made those adjustments, it would or could become a crisis, say in your late 80s, when it's really hard to make adjustments at that particular point. So it's very important to have those discussions and be looking at all of the variables. The variables include, are your assets higher or lower than what you had projected initially? Is your income estimate correct? Is your spending where you had anticipated? Or did you forget to put some things in there? Or do you have too much spending that you're not using? Has your portfolio returns been where you have expected? Is your withdrawal rate at a comfortable level? Is the inflation factor proper in terms of your plan? And has your retirement goals and expectations changed? And going back to the dynamic allocation model, and you're asking the question is, does Bogart Wealth offer a dynamic allocation model? Yes, we do. It is something that we actually have had a lot of requests for. And so our portfolio management team has created a dynamic allocation model. And that is something that is currently in our ability to offer as well. So important to understand when you're thinking about how long will your portfolio last. Typically, when you're thinking about the length of time it's going to last, you have to look at what your withdrawal rates. And as you're doing your projections, this is an absolutely critical part to look at, is what is the withdrawal rate? Early on, you want your withdrawal rate to be as low as possible so that it will sustain your portfolio as long as possible. Typically, if you're looking at 3 to 4%, and this is a slide that's showing an investment return of 6%, but if you're looking at a withdrawal rate of anywhere from 3 to 4%, you're probably going to be fine. A 3%, really, you're probably never going to touch your principal. 4% is probably going to go out about 45 years or so. 5% is going to go out maybe 29, 28 years. Once you get above 5%, it's going to be less amount of years. Now, sometimes you will see in the later years of your planning, you might be taking out 8% in the last 5 years of what your expected life expectancy is to be. But you want to be very careful. If you're taking out 8% in the early years, it is going to put a tremendous amount of pressure on your ability to sustain your plan over a long period of time. So there will need to be probably adjustments that you'll want to incur in that particular area. This is very similar, showing a 5% rate of return. So a little bit less, but very, very similar. So using the retirement optimizer planning process is really, making sure that we start with a reasonable initial withdrawal rate, building a financial foundation, for essential expenses. Take the pressure off of yourself. Know for sure that your essential expenses are covered. We can always change our want list, but we can't change our need list. And so make sure that that is covered and covered effectively. And also be really honest with yourself on what are the needs and what are the wants. Sometimes wants become needs, and they might not need to be in that category. So just be very honest with yourself in that regard. And then you want to have a withdrawal strategy for your discretionary portfolio. You want to use a diversified portfolio that does have a downside protection. And you want to implement spending and withdrawal strategies that, again, going back to that first initial slide, that will sustain market volatility and market performance. Because you want to make sure that your essential expenses are covered for your lifetime. All of these things will increase your probability of having a successful retirement. You want to review and monitor and make adjustments as you need to. So for instance, your spending strategies, sometimes if your portfolio has had a great year, you could probably take a little bit more off the top if something unexpected comes off. If it's had a really tough year, then you might want to think, you know what, let's hold off on that discretionary expense for another year. You want to look at also different withdrawal strategies and understanding the effects of taking things that have had a really good run are at their high mark. That may be a great time to sell it and take some money off the table, and to really make sure that the way that you take your income is also planned out and done extremely well. This whole concept of retirement income is really complicated. And it is something that will continually change. When I have discussions with clients, even clients that have been retired 15 years, I don't think there is ever a single review meeting that we don't discuss cash flow. It is a critical component. And again, from the very beginning, it is something that is really important to always have top of mind. Be informed, know what your choices are, and create a really good sustainable plan. Our expert team of financial advisors are experienced in working with employees of major oil companies. We understand the many choices you have and can help you navigate through those many choices. As you are working with and choosing a financial advisor, it's always a good idea to even start with working with a partner before you retire, because you get it, your eyes are open to all your many choices. Choose an advisor that is a fiduciary. You always want to have a transparent fee structure. Look for qualified and experienced. Look for someone who is a certified financial planner that will absolutely, that they've got the education and the experience that comes along with that credential. You want to look for an advisor that understands and knows your retirement plan, that knows IRS retirement rules, typically that's got some experience in the industry and really understands different dynamic managing different types of portfolios. You want to have open communication. So you want to have an advisor that's open to discussing various strategies. You want to make sure that it's very clear that there is a clear viewpoint of tracking your performance against what your plan was designed to be. And you also want to have good, clear, open communication that really will explain things in a way that you feel comfortable about. Retirement is your next exit, whether you might only be 40 years old, you might be 50, you might be 60, but it is one of those future exits that's out there. We can assist you with the best roadmap to retirement. Have a partner as you're making these decisions. Include your significant other in the conversation. By having that conversation, you'll be amazed sometimes at how different two viewpoints may be. Be ready. Be informed about your choices. We are a group of financial advisors. We certainly welcome the opportunity to talk individually with you, and we look forward to hearing from you. We do thank you for your time today, and we appreciate all of your involvement with today's session. Hope you all have a great day.